This is a special report on the stock market. Bear market comparisons. I'm Steve Miller of VastSlim.com. It's amazing the emails and comments I get on social media that the current big rebound in the stock market has made a bear market low. Some analysts are projecting 4,800 on the S&P by year end. I've been consistent in my analysis saying that this year was going to be a bear market year, certainly is, and that we would get a good rebound around this time, which certainly came. But then I thought the market would resume on the downside. That's based on cyclical patterns and the review of the bear market patterns, which I'm going to share some with you. Bear markets, well, they're never the same, but there are common structures, and that's what we're going to look at. 2022 is not like the crash markets that we've seen in the past, like 1978 or 1987 or 2020 in the pandemic. Those markets were fast and deep to the downside. It's much more like bear markets of the past that followed the peaks in 68 or 73, 77, 80, 2002, and 2007. Those are longer bear markets with steep declines that came early in the bear markets. They had big rebounds also, but then the markets moved to the downside again. All of those markets that I'm mentioning or that I'll be showing, except for the 1968 to 70 bear market, I've traded them all. That will be the only one that I did not trade. So I've seen or traded all of these bear markets except for that one. So what I'm going to do is I want to compare 6 bear markets to today. I'm not going to show cycle analysis like I have in the past. This is much more about comparing market structures and the way that they look and how that compares to the present market that we're in now in 2022. So there's something about the bear markets that I think are important to mention. I got this off money.com that put a recent article out, and I thought those were good stats to know. The average duration of a bear market is 16 months. The average decline from peak to trough is 35%. Recessionary bear markets average about 20 months. Non-recessionary bear markets average about 6 months. The current bear market, 2022, is 5.5 months approximately from peak to trough and lost 24.4% on the S&P 500. 2022, the recession is still in question. There 2 quarters of negative growth is supposed to be what a recession is, and we have that here in 2022 already. That would qualify this bear market as existing in a recession. However, we don't know that's true yet, and the question may be, is it 2 quarters or is it 6 consecutive months? And if that's the case, well, based on when the economy turned down, we don't really have 6 months yet of negative growth. And you have to ask the NBER, the National Bureau of Economic Research, because they're the ones that are going to eventually say whether or not this was a recession. And we might not know that for 6 months or a year, based on how long it takes them to decide. So that's where we are right now in 2022, and some sense around what the bear markets are really like. So now I want to compare 6 bear markets to the bear market today. Again, this is not cycle analysis. This is just looking at durations of bears, the depth of declines, and the structure of them, and how often a market that falls pretty hard early on in a bear market has a rebound, and how long that rebound lasts. That's really what we're doing, is comparing those rebounds, because that's where we are right now, in a rebound. And the question is, will this rebound fail and the market move to lower lows, or is the bear market over? And then the market, again, moves to higher highs, which I believe is a low probability. So let's take a look here as we look at the 1968 to 1970 bear market. And what I have here is the whole bear market right in here. And where it declines down close to that measurable bear market low and then gets a rebound. So this 1968 to 1970 bear market eventually was an 18-month bear market where it lost more than a third of its value, 37%. This is what's really interesting, and that is 31 weeks into the bear market, it had a decline of 19.2%. It then had a rebound, and that rebound lasted 13 weeks and got up 12.7%. I put in the key Fibonacci levels so you could get an idea of the amount of upside retracement. Now, while it was a 12.7% advance, it got up to about the 50% retracement. In other words, it made back about half of what it lost in here. But then you could see once that was over with and what was a bear flag ended in that resistance area, then it turned down again and lost again practically what it lost here or more. So this is the structure of a bear market that's quite common. And I'm going to show you that as we move forward. So let's take a look at the next year right in here, next bear market, which is 1973-74 bear market. You can see the similarity in here in the structure. That's really what we're looking at. This was a 20-month bear market. Of course, there was a bad recession in there based on the energy crisis. And that 20-month bear market lost 50% of its value. Now, this is so interesting. 29 weeks into the market, it was down about 18%. And then had a rally. And that rally lasted 7 weeks. Excuse me. And then that was up about 13.1%, and you can see here it gets back up to that 50% level. So in other words, it gains back about half of what it lost, but then when it turns down again, it has a full-fledged second leg to the bear market and has a big decline. Just an interesting note in here is that I started trading May 20th, 1974, right on that week over there. So you can see that I started trading in the midst of a bear market that continued at some depth, as you can see, with the market losing still about a third of its value after the time that I began trading. So very important here, 29 weeks, 18% down, and then a 7-week rally of about 13%, and then the bear market resumes. This is basically the same structure that I showed you looking at the previous chart right there. When you look at 1968, that one right in there, coming down 19.2%, rallying 12.7%. In 1973, coming down 18%, and then rallying 13%. So you can see the similarities in there, pretty much in the middle of the bear market. Let's look at the next one, which is the 1977 to 1978 bear market. Now, what's notable is that bear markets tend to have an average distance or length from trough to trough of about 53 months. It comes out to about 7 quarters. And I've done some big picture analysis in the past showing that. So if you want to look up some of our other videos, you can see that. Now this one, as you can see in here, this decline right over here was small. It was like 10 or 11%. So I didn't note that because really what I want to do is when it starts to approach that 20% level. Still, you could see this rally in here was about 7 weeks. It was only 7.4%. And this one right over here was also very short, 4 weeks, close to 8%. This got up to the 50% fib. This got up to the 38.2% major fib. And you can see those ended up to be resistance levels. Now, what's interesting about 77-78 bear market, it was rather shallow. It was 13 months. It was 20% on the downside. So the comparisons may not be great to other markets because it wasn't a deep bear market. And the rebounds, the corrections in the middle, though they hit the proper fib levels, did not get up very far. So it may not be the best comparison, but you could still see the structure in there is pretty much the same as I showed you in the last two. Let's take a look at the next one here, which is 1980-82 bear market. You can see how these bear markets come in great regularity. So here I had to go out to the 40th week over here before there was that significant rebound. And again, this is going to be interesting. 22.4% down in 40 weeks, and then a rally in here that lasted for 10 weeks, and it rallied 15.5%. And look at this again, right up to the 50% fib right there, and then came down and completed the bear market, which was 12 months long, at just over 26% on the downside. So you can see in here when it finally got going in here and everybody started to think, well, bear market is over, it recovered half of its loss and then got sold off again very significantly after that. So you can see the similarity in structure, and that's really what I want to look at as we make these comparisons. Here is the 2022 bear market, and this is after the dot-com bubble and the bursting of that bubble. There were a couple of rallies in here that were measurable here. 29 weeks down 29.3% is fairly comparable to what we did in 2002, and I'll show you that, of course. And then this rebound, 21.6%, right to the major 50 right there. And then it started to sell off again. Now, I didn't mark this off right over here, what the percentage decline was at that point, but the rally after that, so there were two of these big rebounds in here, 21.6%, 24.4%. This one only recovered just over the 38.2 of this distance right in here, and then sold off for another decline. 55 weeks is about just over 1 year. About 12 months at just about 50% on the downside for this bear market, 2000 and 2002. And you could see these strong upward moves where, you know, everybody knows that we were in a previous bull market and they think it's going to continue again, but the bear market has a lot more to go at that point and much deeper declines followed after that. Here is the 2007 to 2009 bear market. Now, this one, again, similar to what we have going on right now. This was a 22-week decline of 20.2%. It then rallied for about 8 weeks, but only about 9.3%. That wasn't able to get much of a rally. And look at that 50% again. Man, it keeps showing up in here. And these end up to be bear flags. And you get these rallies where the in the case of this in 2007 to 2009, things start to look cheap when you're down 20%. So you get a nice rebound in there, but only 9.3%. It wasn't that huge, and then the market had a lot to go on the downside. Of course, this is also not that comparable to the norm. This was the Lehman collapse right over here on September 15th. And of course, this all happened after the government and the Fed greatly inflated the markets, and we had the mortgage bubble in there. And when they burst the mortgage bubble, then a lot of the financial institutions were under a ton of stress. Bear Stearns going out earlier in that year, Lehman collapse in September, and the market continuing to go to the downside. So, of course, the Fed was easing during this period, and when the market collapsed and recession is likely, Fed eases and interest rates come down, but the stock market still falls. I mean, that's an important thing to look at when you consider the effect of interest rates on markets. So this is that look, and you can see very similar to what we have here. Now I'm going to show you 2002 right. Before we go further in the video and I show you that next piece of analysis, please do go to AskSlim.com and sign up for our Popular Services Preview. That is free. Sign up now. It begins August 5th and lasts through August 26th. You get all of what you see here on this slide for free. No credit card necessary. We just want you to get a good look at all of the amazing things we do. So go to AskSlim.com right now and do sign up. Look in the top of the page and you'll see that sign up link. Thank you. Now, 2022, and this is the present bear market that we're in. So what do we have? And remember what I showed you in previous bear markets that actually lasted, not crash type markets. This is a 24-week decline of 24.4%. This is actually pretty much steeper than any of those other markets that I've seen that I showed you here. But still, it was similar in length on the downside, probably to the average declining period, and now we're getting that sharp rebound. So far, 6 weeks, 13.8%. It is a very good rebound. Now, remember that almost all of those charts I showed you had rebounds to the major 50. In this case, the major 50 is just over 4,200. And there are some important numbers around 4,240, which I have shown to members on the shorter term charts. That may be where it headed, and in that case, it'd probably be a 17–18% advance. And here at 6 weeks in the rally, it's relatively short, so there's still likely some time to go. So you could see how well this compares to the other markets, but still the likelihood of getting a resumption of the bull market out of this based on all the comparisons looks extremely small. And I'm going to give you some of those other thoughts as we wrap this up. But if I were to make a projection based on what I see here compared to what I see in the other markets, it would look basically like this right over here, where this is the highest odds projection in this 2022 bear market, where it continues on the upside in here for some number of weeks, probably gets somewhere just basically over that major 50% fib, and then moves to the downside again after that. Now, our longer term projections have the bear market going out to potentially out into 2023, and you don't have to quite get the steepness in here or the short duration that I'm showing here, taking out that low in October. It could happen differently, but still we believe the probabilities of getting through that resistance zone, I mean, none of them made the major 61.8%. And in this case, if it did that around 43.75, we would look at this being a stronger market than those other ones that we have shown. But this is what the projection would look like based on the comparisons that I've shown to this point. So let's talk a little bit about the market that we're in now, the 22 bear market. Stocks rebound on in a very sharp way on the word normalization. Powell said that word, and the market took off in a huge way. Because to them, that indicated that he wanted to get a little tighter, more restrictive, but basically he's on target, and that the Fed they indicated there would be slower increases in coming meetings, though their dot plots looked like it's going to go up to 3.5%, maybe 4% out into 2023. So that's not really stopping the upward movement in short-term rates. It might be a little slower pace. The end of July, S&P 500 valuation was 180% of GDP. Now, it was 200% or so at the peak. 180% of GDP having rebounded now to that level is historic. 200% was historic, 180% is historic, and even the bull market peaks of 2000 and 2007 did not get near those levels. So the reset of valuations is far from done based on what I see. That historic valuation puts a cap on potential increases. Inflation is the huge issue, and analysts expect it to decline, and so do I. The numbers that they're looking at are about 4 to 4.5% towards the end of the year or into 2023. The Fed's goal is 2%, but their goal was 2% when it was 1.7, and look what they did. They destroyed the economy and really put shudders through the markets. This will still be high for the Fed, likely to raise rates. That inflation number will still be high for the Fed, and they're likely to raise rates into 23, as they're saying. Now, this is very important. The Fed lost credibility because they said that they could, that they have the tools to prevent inflation, and they didn't. They stimulated the economy with the government to just stupid levels. And now they have to prove that they can control it. It will have them keeping rates high for a long time. There is no cycle coming soon where they are cutting interest rates. That would take a very deep recession for that to happen. Right now, if there is a recession, it's pretty shallow. And that might not happen until 2024. They want to get restrictive and stay there. They need to cure the inflation out of the economy. And people are saying, okay, they're slowing down here, all clear, time to buy. Well, that's not the case. In fact, it's far from the case. If the Fed stops raising rates and stopping their balance sheet runoff, commodities will soar. I want you to look just in this last week that ended on Friday the 29th, July 29th, silver exploded to the upside. There were good rebounds in metals. You saw the other commodities move up very sharply. The grain markets began to move up. The oil market began to move up again over $100. The response to any sense of Fed easing is going to bring higher commodity markets. That's a feedback loop that will keep inflation high and keep the Fed tight. At the end of 2022 and into 2023 could easily be a period of stagflation. That would be still high inflation and recessionary market or very low growth in the economy. That is not an environment that gives you increased earnings. It is not an environment that is likely to bring the stock market up to any high levels. So the odds are high of the bear market continuing into 2023. Of course, anything can happen. I could be wrong. We could go to 220% valuation to GDP and into a period of further insanity. I certainly doubt that's happening. And I'm just simply sharing with you the research that I did so that I could understand what's going on in the markets better. So these are just my perceptions. But when I put the sum of the evidence together, and when I look at our analysis that we do for members, which is cycle analysis, then it says to me that this area that I showed, just over the 50% retracement, is likely to be what stops this rebound. We'll know if this gets a lot stronger that something very different is happening, but for now, I think that's a low probability. And I hope that what I shared with you has got great value to you, and that it makes some sense putting this together the way that I did. That's it for the big picture analysis, the special report comparing bear markets of the past with 2022. Don't forget, go to the top of the AskSlim.com website and sign up for our free trial. There's no credit card necessary at all, and you'll get to see our most popular services from August 5th to August 26th. Everything that you see right here on this page. So sign up for that right now. I hope to see you in the next segment.